96% of stocks have over the lifetime have the returns of 1 month US Treasury bills, essentially, so like short-term T-bills. The biggest thing that started me out was we had like an at-home stock market my dad started. Like we would have basically our own like stock certificates almost. The best way for younger people to, build wealth is investing in like your education and your earning ability.
Welcome to the Kaizen Blueprint, the podcast dedicated to helping you achieve a better life through continuous improvement. If you're ready to elevate your finances, grow your investments, and unlock your full potential, you're in the right place. Each episode brings expert insights on personal development, finance, and real estate, giving you the tools to build lasting success. Now, let's dive into today's episode. Joseph, how are you doing, bud?
Good. How are you, Aldo?
Good. I put you on this podcast mainly because we got connected through the Sheiks Freaks community, and that we kind of connected a couple of weeks ago, or maybe it's a few months ago. And I realized that you have this gift of explaining stuff in financial planning, taxes, and just overall, personal finance stuff. You have a really, really deep knowledge. But before you kind of conjure up all those knowledge and learning all these stuff and talking to many people, what was your life like before? I know you're still young, so tell us about your age. And then how did you get started in this, everlasting journey?
Well, currently I'm 18 years old and I am a financial analyst and tax preparer at Amicus, basically financial planning firm out of Lubbock, Texas. Mainly, that's where we operate. And I think really where I started my journey on personal finance, I was about 8 years old when my dad just started teaching me. He was like, there are some, benefits to learning about, investing, debt, understanding cash flow. And he really tried to instill that because he's an engineer. So by design, he just likes to learn things. And he didn't really like how he wasn't really taught this in school. And he just said, like, for me and my brother, he really wanted to ensure that we, learned. So we really started with the biggest thing that started me out was we had like an at-home stock market my dad started. So we would have we would just like write, like we would have basically our own like stock certificates almost. We would write down, we would own Amazon stock or let's say Google, Facebook, things like that. And we would just like write down, how many like shares we did and like fractional shares before those existed. Because we were investing like, let's say $20 or $30. And then we just started doing that. And he just wanted to do that because he really wanted to teach us, just like, recording things, understanding, what a contract is. And then from there, what does it mean when you invest in a company? While now I'm a believer in index investing, and I can get more into that and, the theory and evidence behind indexing. I think that was a great starting point, mainly because it got me and my brother connected to the businesses that we owned. Like, let's say for FedEx, for example, was one. I think me and my brother were a lot younger. He saw I think it was actually during COVID, he saw a FedEx truck pass by. It's like, oh, I own that stock. So it's just like, he just wanted us to have that connection, which he did not feel we would really understand. And like, we physically would write this, sign it, it felt like we were doing something, a lot more, especially given the younger age. And I think that was really, what kickstarted my journey in financial planning and why I'm here currently on this podcast.
That's awesome. One thing that I noticed is your dad did the stock market aspect. Most parents tend to, especially in the personal finance journey, it's more about like savings and personal budget. Was that instilled, or did you like jump into the stock market thing? You own a business, start investing. Was that kind of the first step in that journey that your dad instilled in you?
No, I would say like that was probably what got me the most interested. But like along that journey, like he would teach like the investing part, but I think he just tried to find a way to like, connect with us in any way. And he felt, at least at that time, the best way to connect with us is through investing. But he did teach us, things about savings, and like before we understood like what a 401k match was, we kind of like did that, but we just didn't understand what that meant or what it was. So like he just tried to instill, just like really just the basics, how important savings is, and, just really thinking about like your future self and not only like your present self at all times. But I think that the investing piece really did help me, especially, start understanding, what could potentially happen if done like, very diligently, how much your outcomes can be very good.
Got it. And what is like kind of the biggest takeaway that you have with this exercise?
I would say the biggest takeaway here was that, you can't just think always for today. If you always think for today, you're really going to hinder yourself from doing anything because there's much more to life than today, especially from a younger age. Like we don't understand or have that perspective most of the time, but we have usually decades more in our life. And while I'm not a proponent of just saving everything, as that doesn't really make sense, there has to be some sort of middle ground. You can't just like live for today, but you can't also just live for like the future. Got to have some sort of middle ground. And I think that was just really what my dad has been instilling from the age of 8 for me, because there's no need to try to do anything in a too extreme of a manner. But if you don't really start, then you can't, like, it's not really going to be very good for you. And I think me starting out younger really got me, learning, getting over any potential errors that I would make otherwise. Instead of making it in like my 20s, 30s, or 40s, I made it when I was mainly at home. It wasn't really much money on the line. And, that's eventually how I got to indexing and, my other knowledge because of the errors and, misconceptions I had early on.
Got it. For the listeners that might not know what indexing is, can you explain a little bit what that is?
So basically, indexing is like the S&P is probably the biggest index that people are aware of. It owns about like 505 of the largest companies in the US based on market cap. And really, the importance of indexing here is that when it comes to indexing, you're owning a large basket of securities, basically stocks in this case, and you basically have ownership in a business. So I think just stepping back from indexing, basically, when you own a stock, doesn't matter what the stock is, you have the right to their future earnings. And that's important because when you're investing in any way, even if it's an index fund or anywhere else, you want to understand what you're buying. People just think of like a stock or something else as just a symbol that moves up and down, but it's much more. This is like you have the right to the future earning potential, and the risk you're taking is how you're going to be compensated in the future. You're expecting to take risks, and you're also, because of the risk you're taking, you're trying to expect a positive return. And with that piece of the positive return part, it's important to understand that not a lot of stocks actually have positive long-term returns. This is actually very interesting. And what I've learned over the past few years is, I think, from Hendrik Bessenbender of Arizona State University, pointing out a study from like 1926 to, I believe, like 2019, 2020. He updates it, every few years, but really just pointed out how about 96% of stocks have over the lifetime have the returns of 1 month US Treasury bills, essentially. So like short-term T-bills. And all a T-bill really is here is just like you can think of it like a high yield savings account, except you're just giving money to the government and they give you, an interest rate accordingly. So like nowadays you probably got like 4%. Last year was like, closer to 5 when interest rates were higher. And that's really important here, and why, indexing in my mind is important, from a foundational level, besides just the definition of it, is that because you're owning these basket of securities, you don't have to have all of them do well. It's just the very few, like, Apple, Amazon, Tesla, that people know of here, that really cause you to have, great outcomes. And we see like the great returns you have over the long run for, let's say, like the S&P 500. I think that's really crucial for the audience here to understand, because when it comes to indexing, it's really just you're trying to take the appropriate risk, but you're trying to also understand you don't know what's going to happen in the future. And the data here proves it. And just foundationally, you believe in, let's say, the US economy will move forward, but you don't have to bet on X stock or Y stock. You can just bet overall. And the companies that do extremely well, that have tens of thousands of percent gains, those really are the ones that push you forward. And I think really where people should be focusing on when it comes to the investing piece.
Got it. I really enjoy your piece about mentioning that it's the appropriate risk. Do you think with the current stock market, right? You're looking at the S&P 500, but it's predominantly taken from, I guess, the top 10, maybe the top 5 companies. And if you look at the index, the rest of the companies have kind of a smaller piece and they're not doing so well. What are your thoughts on that? Should it be maybe like S&P 100 or S&P, I don't know, 10? Like
I see.
what
Yeah,
what would be the difference on that?
I think that's a great question. So really right now, a lot of, tech companies are really lifting up the index and causing majority of the index to be tech heavy. I'm not sure exactly what it was, but I'm pretty sure like over 20% of the index is like, more predominantly by like is predominantly taken up by tech companies. And I see the concern a lot of people have about, that's not really as diversified. Because the reason you want to index is because you want to gain diversification. But I think that to further the point on diversification, I think a lot of people over the past like 10, 15 years just think the stock market, like the US stock market, is the only stock market. But we really have to understand that there is more to the investing piece of people's lives, more than just the US stock market. You really want to be investing globally, in my mind. Like, of course, this podcast episode is not like investment advice or anything, as I don't know your situation, but it's very important in my mind and at the firm I work at. We just try to always instill in our clients that global diversification is very paramount, because you don't know what country or what sector is going to do well. If, let's say, you invest in the US, there's been bad outcomes, let's say from 2000 to 2010, where the US did not have any returns, while the international markets did pretty well, and emerging markets specifically had very positive returns. And what I want to really ensure that the audience understands here is that when you're investing, you want to be giving yourself the best chance of a good outcome. There's no guarantee of a good outcome. And really, humans don't really understand or can conceive the distribution of outcomes you could have. But because of that, you want to try to put the odds in your favor. If you just own, let's say, a global index where you're owning stocks in the US, Europe, Asia, anything like that, you're really just saying, I don't know what countries are going to do well, but you can say that most likely over the long run, I would say that the human nature to try to continue to innovate, grow profits, because that's the incentives these businesses have. The few percentage that do extremely well, those are going to lift my portfolio higher. And that's really going to, be the easiest thing to do. Because in my mind, you don't really want to be like stressing about your investment. There's much more to life than investments. I think, Cody Garrett, an advisor I highly respect, points out how, you want to be like less active with your investments and more active in your life. And I think that's really where people should be focusing on, rather than just, stressing about, oh, what stock should I be purchasing, or, things along those lines.
I really enjoy your bit on the best chance of a good outcome. But, I'm thinking when it comes to trading, right? Do you play poker at all?
No.
Or okay. In a game of poker, the amateurs tend to focus on the bigger wins. Like, what are the possible way, or what is the maximum return or the maximum rewards can I put or potentially put when it comes to this hand? However, that's the amateur side. Like, they think of it as the complete upside. However, in the pros and poker, they tend to focus on how can I minimize the amount of risk, the amount of losses I will take. And then when the opportunity comes, I will go all in on that. In terms of your experience with, I know we're talking about indexing, right? This is more of a safe play, diversified. But let's say I'm a little bit more advanced. Maybe I'm a trader, I'm a day trader. Do you see that as the same concept for the people who are just maybe on Robinhood, right? Or just a brokerage system where it's pretty quick, versus someone who is an actual, knowledgeable person who knows trading, who knows stock markets, things like that. Do you see that differences in that regards?
Yeah, I would say, like, people who are more amateur, especially during COVID, like they do get caught up into, like, quick wins. But I would really just say, overall, most people, no matter how skilled they believe, I think people who, day trade, swing trade, whatever it is, I believe they're overconfident overall. And I really think here that the data backs it up, because I think it's like over 90 something percent of day traders lose money. And I think the reality here is that people really overestimate their skill. And I think the important thing here is to understand, how am I defining this skill? Like, clearly, people nowadays have better technology, more knowledge. So you would think they would be able to, outperform the market, or, get an edge. But you have to understand that everyone else now has it. If this was like, let's say, 30 years ago, with current technology, current knowledge, yes, you could probably have a good chance to outperform. But nowadays, you're basically competing against somebody else with similar knowledge. And really, because of that, it really comes down to luck. And I think this is really shown in the data on actively managed mutual funds, where there's these like skilled managers, like CFA charter holders. They really study this day in, day out. But over 90% of them, over like a 20-year period, fail to outperform the index, according to the SPIVA reports. And this is because they're competing against others. And of course, higher transaction costs. You don't pay like the fees for the funds, like maybe when you're day trading, if you're only day trading individual stocks, but you're always going to be competing against other skilled people, and you're always going to have the cost of taxes in a taxable account. And I don't think people really understand that. I see most people, when they trade, they don't understand really the full tax consequences that they have, most likely paying, short-term capital gains, which is, at extraordinary income. And that really can take away a lot of your returns. Like really, when it comes to investing, you just want to be very consistent. And that consistency, it really is what's going to help you over the long run because well, since these returns compound, if let's say you're doing very well, but then you have 1 year where you have very negative returns, that will wipe out many years of those positive returns you've had. But if you're just very consistent, that's really what's important because the negative returns compound against you and the positive ones for you. So, you really want to have the minimize those negative returns and really indexing is, theoretically and empirically backed, showing that that's probably the best thing for, most people to focus on when they're trying to invest in the stock or bond market.
Got it. And so consistent growth, that is the way to wealth, right? It's safe and it's great. However, it's slow, right? For some people like you, some people like me who are younger, we know this, that the younger crowd, especially people around our age, they want money quick, fast, right? How can I maximize the return? They're willing to take a huge risk, right? Huge risk, huge rewards. I know you talk about taxes, and we'll dive into taxes a little bit later, but in terms of the younger generation, what do you see like is the problem? How do you see that we could fix it? And what are the ways that the younger crowd can build wealth in a way that they want to, right? And maybe a little faster, not too fast, that is too risky. What are your thoughts on that?
Yeah, I think the biggest thing, no matter what your age, but especially if you are a lot younger, I've actually done this a lot. I think the best thing to do is, just go into a compound interest calculator. Let's say you assume, let's say the market's going to return, let's say 7% per year on average for like the next 20 years. But then let's say you say, oh, I'm going to outperform the market, let's say by 1 or 2%. Let's say you say 9% is my return over the next 20 years. What I would say there is like, okay, let's just even give it to you. You're guaranteeing yourself you're going to outperform the market by 1 or 2% consistently for the next 20 years. The odds of that is almost nothing. But even if we give it to people that they're going to do that, especially for younger people, I would say then, what is the time that you've wasted there? Now, let's say if you're probably going to outperform, you would have to be very consistent, very diligent, and very lucky for one. But even if we get rid of the luck part, you're gonna have to be consistently spending time. Like, gonna be spending 5 hours there, 10 hours, 15 hours. And I think overall, that's gonna be really wasting a lot of time. And I think if we just put things into perspective, if you just have your investments, you're investing well for your future. But then on top of that, like that you're investing, let's say, in the stock market. But then I think the best way for younger people to, build wealth is investing in like your education and your earning ability. I understand, let's say somebody's a fund manager or something, them investing a lot of time, into trading or picking stocks, that's great. But majority of people are not fund managers or anything like that. But if let's say somebody, let's say is a real estate agent, devote time, learning more. Let's say somebody's an engineer, devote time, learn more about that. If you're a coder, if let's say you're a doctor, how do you get better at that? And getting better at that skill is actually going to pay bigger dividends and trying to outperform and way more likely to happen. Like let's say you consistently get, let's say 10%, 15%, 20% raises, or you start a side hustle or something, you have way more income now if you're able to invest just a little bit more instead of wasting so much time on the investing piece, like right in the stock market, rather than like, investing in yourself, which will always have the highest return. And I think people have to put that into perspective, but I think it's harder to see because you can't see the value of it going up like you can see like in Robinhood or something like of a stock. And I think people have to put in perspective that the best investment will always be yourself.
Got it. Yeah, that's really, really good. But what if the best investment in yourself is on the stock market? Like, what if we're learning about, what Warren Buffett does in terms of 10K? Like, we want to be the next investor. It seems like what you're recommending people to do is focus on like the main skills that makes you a lot of money and use this investing capabilities as kind of on a passive side, right? Maybe just invest a little bit weekly or monthly based on the pay stub that you make, put it into index funds, let it grow, don't sell. And, once you get older, and you feel as though that you need money to buy a house, or you just want to divest because you earn so much, yeah, you could do it smartly. But is that where you're heading at?
Yeah, and I would say that that's probably the best thing because like I've seen a lot of people when they get into the investing world, well, once they start, thinking that they're, smarter than everybody, they're going to start gaining, there's a higher chance bad outcomes are going to happen. And I've seen it like, even with some of my classmates in school where they just start seeing, some crypto is going up or some stock and they just start putting everything in it, but then a bad outcome occurs or probably a more than likely bad outcome because everyone's, pouring money into it. But when that happens, a lot of them start getting discouraged and, stop investing. But they're really focusing on things that are like, less meaningful. And I think as long as we put things in the perspective of what's more meaningful, I think that's, the best thing to do.
Yeah, I agree. I kind of see this on my own personal investing journey because I think maybe 16 or 18 when I bought my first stock either under my dad's or under or myself. I remember it was from a company, I think Slash or it was what it S. It was before the Robin Hood. It was before all the stock brokerages that I learned. But what I did was I was focusing on working my side hustles, or I was working at a server job at the time while building up my real estate knowledge. And I remember all I did was putting $100, maybe $50 if I don't get paid well on like a weekly or biweekly, depending on my pay stubs basis, and just let it grow. Like I didn't even know any stocks or specific stocks. All I know is there was like a category. It was like if conservative or risky, and I choose whichever the one. Like I didn't even know the stocks. So it was kind of like an index fund in a way, but without being called index fund. They just choose which stocks or bonds or whatever markets at the time. And I was just investing in it. I never sold, and I translate or transfer out of that into what I use now, which is M1 Finance, which is what they do is kind of like a pie chart. So you have your own quote unquote index funds and you get to choose. And this pie chart is pretty cool because you could dictate what percentage of the set stock that you want to put in there, or even index funds that you want to put in there. And it kind of grew more and more. And for example, right, because I've been focused on real estate, and then any money that's coming in, I just put it into there with the hope of it going more, which it did. For example, I never took a look at it, but apparently one of the indexes or like one of the pies that I invest was Nvidia. And people were looking at Nvidia when it shot up, what, 200% or like 50% or something. It was just a crazy thing because they were like the AI and there was some news about it. I had Nvidia for like a few years before it stocks up, and then it just gave me like a jump of joy. I was like, oh wow, I'm getting so much percent out of it. I didn't even know that I invest in it, but like I wasn't focusing on it. The main thing where I'm getting at is that, as you said, focus on the main thing, right? Let this be an automated thing, unless you're like a financial planner or some sort of finance person that is completely involved in this on a day-to-day basis. But if you're just a regular, schmuck like me who is focusing on completely different things than the stock market, then I think keeping that on the passive side and then working on what you're really, really good at would pay you dividends. And then when you focus on this one, just let it grow. Just I was more stress free now just because, okay, I just put a money aside and it's automated. It's like the same thing on your expenses, right? Or your credit card payments. If you pay it on a monthly basis and you pay it in full, like you don't have to worry about it. It's automated. You could worry about something else rather than these small little tweaks in your finance that can be automated.
Yeah, I mean, I definitely completely agree. And I think, M1 Finance, I've seen, some things with regards to that. And I think the idea of the pies there, I think, are, very crucial for people to understand. Because, like, let's say you had NVIDIA, if you let it just hold an index, you're going to have those companies that, performed very well. It's just that you might not have, like, not all the money is in it. But I think
Sure.
people, have that sort of perspective. I think it makes things a lot easier. And, when you keep it passive and, more active in your lifestyle, it makes life a lot better, as you said.
Yeah. Yeah, absolutely. Let's shift gear here and talk about financial planning, right? In today's world, I could go on YouTube and look up finance, like personal finance. I could go into budgeting tools. I could look up different ways to optimize your finance, right? That's a word that's been buzzing around. Optimizing. How can I make this better? How can I make this even more complex than what it is, right? It's your It's your income, your expenses, and that's your cash flow. And whatever cash flow that you go, it goes into many different buckets. But you're in financial planning. You help people with financial planning. What is that, and why is that valuable, especially in your world?
I would say really, for me, I work at a firm where we specialize in helping personal injury attorneys and their clients, mainly with their legal recoveries and, financial planning and settlement planning with that. And I would say like this internship so far is really giving me a lot more perspective and understanding that I think the biggest thing that people should be looking for, like rather than optimization, I'm one for optimization. And this is like, what I learned, going down the Kitsis blog or, learning from Cody Guerra or many other advisors. But I think the biggest thing people should focus on, is just like the big thing, like the 80 or 90% that actually move the needle. And I think that that's why I really love financial planning because things can be like, very individualized and, because people are all different and, in some ways, maybe some investing things, some things could be the same, but, a lot of clients tend to be different in what they want. I think financial planning really gives people access to, living like, tying the people's like, ability with money, shoring up that knowledge to live the life they want. And I think that's really why I fall in love with financial planning and, why I'm trying to make a career out of it.
Got it. So, what do you see in the mistakes people make once they get a huge claim? I mean, you could do claim, you could do lottery, right? You could spend so much money, but is there specific mistakes besides the typical stereotype that you see that people do when it comes to receiving a huge amount of funds?
Yeah, the mistakes really we see from our clients is that, when people gain these large legal recoveries, is it's probably more stereotypical. It's just that like people just tend to spend it similar to lottery winners. But I think the other thing is just that like, since this usually happens in a more devastating time of their life, when they gain these legal recoveries, it's very important, to try to communicate with the client, and sometimes it's harder to communicate because, that trust piece, they had this devastating event, and now you're stepping in, we step in the settlement planning and like, and then the financial planning process. When we step in, it's really hard for them, to process everything. So like they've already made some decisions mentally. And, it's really about, understanding where the client's coming from and really communicating. And I think that's really for all clients, not just somebody who receives, legal recovery, because, regardless of who you are, there's always going to be something that is harder for you to communicate, harder for you to understand. And because of that, I think really, financial planning overall, well, there are technical things like, insurance, estate planning, your investments, if you can just really just drill down to, what you want and, really the goals and the aspirations you have, I think that's the most important thing. And, whether one works with the financial planner or not, if you can just like think about that on your own, what goals, what aspirations do I have, that will really lead a lot of the discussion and thoughts in like more technical aspects of financial planning.
In terms of financial planning, this is more on a general side, right? People tend to have a scoreboard on their life based on the monetary value that they will get, right? I want to get $1 million. I want to make X amount of dollars every month and you kind of see this looping around in real estate in terms of goals. Like, what's the amount of cash flow to make you feel comfortable to live your life that you want to live, AKA financial freedom? Financial freedom is very, very subjective, but what advice would you give to someone to make sure that their financial goals are more specified as opposed to I want to make $1 million, right? That is so stereotype and everybody say it all the time. The $1 million now is not the $1 million that years ago, decades ago that people want to wish for. It makes it rich, right? $1 million doesn't make you much money anyway in today's world. Maybe it is for some people, but with today's inflated economy, it doesn't seem like so. But going back to my original question, how can people be more specific and what are in the process to make sure that their goals align to who they are?
I think really just like these like stereotypical goals, I want to have X amount of money. I think it really does push people into, focusing on, the wrong thing. Like I've seen a lot online. It's like you need a $3 million to retire or 1 million or 2 million. I think the biggest thing is just, let's say like some people's goals, like some people want to buy, specific car, go on a special vacation. Let's say they're trying to retire and let've deemed their lifestyle, going out, purchasing a house or something like that. Let's say they want to spend, let's say, $50,000. I think now backing into, what you actually need is the biggest thing and most important that people should focus on, rather than, just what people say you need to have X million or whatever, because that doesn't really, add a lot of value to people. And, backing into that, you'll probably be surprised. Maybe you're going to need a lot less than people said that you probably needed. And I think that really does help out a lot of people in understanding, you're able to live your life in a far better way rather than, living the life of, other people. And you're always stressed like, oh, I can't reach my goals. It's really, and once you identify those goals, whether it be retirement, house purchase, car, things like that, once you find those, you're able to back into the cost a lot better. And when you're able to back into those costs, you have additional perspective. And I think really that's what the financial planning process to me is about. I've seen a lot of advisors, specifically Cody Garrett here, point out how clarity precedes confidence. And I think that's very important. Once you're very clear on your actual, current situation, that can give you a lot more confidence and perspective and understanding, what you need to do. And, if you're able to get there. But, I don't think there's not a lot of clarity provided when you're just like, oh, this person has 5 million or this person says I need X million. It doesn't really help a lot. I think that's really the downside to things on social media. But, learning from things like this podcast, if you really focus more on that, I think it really will improve your life and, focusing on things that are far more important for you.
There's this quote by a very famous rapper who unfortunately passed away, and it's "Mo money, mo problems." Is it true?
Yeah, I would say really that really just depends on the person. I would say, money really just magnifies who you already are. So like let's say somebody has, let's say, $1 million and they're always just miserable. They don't really don't like everything. If they have 10 million, it's not going to really do much for them. But like some people might have 1 million and they're ecstatic, they're able to, live the life they want. Maybe they're able to withdraw 50, $60,000 with other income sources in retirement, and they're living the life of their dreams. But other people, if they're focusing on just like some status thing, then they're not really happy. And I think, just understanding really what brings you happiness, I think is the most important, which is why for me, I've loved financial planning and will probably continue to do it regardless of my age or anything. I'll just continue for many decades to go from here.
Yeah, that's awesome with your passion on a financial plan. It's not always about the big goal. And I think for most people, right, they have this, I think Cody Sanchez mentioned this, for most people, they have these financial goal outcomes and they think that it will change their complete personality and their character, right? They think that, oh, once I make $1 million, like I'll be a complete different person. I'll do this and do that. But at the end of the day, you're still in the same a-hole as you were without any money versus the one once you have like $1 million, but you still have the same personality. I kind of see that with myself too. It's like, okay, if I make a certain amount of money, this is going to change my entire life. And at the end of the day, it's just numbers at a bank account, which allows you to do whatever you want, which is always amazing, right? That freedom to do whatever you want. But I think once you reach a certain level, it kind of shifts a little bit that it's not about the money anymore. It's about creating value for other people and helping other people. Financial planning, there's so many different nuances. It's like you have a personal coach for your financial life. However, estate planning is what happens if you die or your loved one dies, and what is the planning after that? I feel like for a younger crowd, they don't really think about that, except when their parents are potentially going to pass away, unfortunately. What advice would you give to someone who is young and, they saw in a workshop maybe, right? They go to a conference and there's this called estate planning and there's some lawyer who is explaining stuff about estate planning, but in your head as a young person, you're like, nah, it's not really important to me. I know you have a different take on that, so let's hear it.
Yeah, I think I probably could have had a similar take a few years ago, but I think really just one, like, learned more about estate planning. It's not just about like transferring of assets at death. And I think that's really the important part for younger people. When it comes to someone who's a lot younger, especially with dependents, I think having an estate plan, mainly when you have your will, you actually designate who is your guardian of your dependents. I think is very crucial because people, I don't know if they understand this, is that if you don't have any specific guardianship, especially when you have kids, and like in this scenario, you're allowing the state government to decide that for you. And I don't think really that's a great thing. yes, there could be some problems, it might be hard to decide, who is going to do it. But I think making a decision, you can always update these documents like a will, and I can go more in what is needed for a proper estate plan, some basic documents. But I think it's very crucial to understand, you just really have to get started. I think a lot of people think of this as just like, this is a very bad topic to talk about. It's very difficult to talk about. And while I do agree with that, if this is not discussed and not very transparently, it makes things a lot worse when a lot of these things do happen, like inevitably will happen at some point in one's life, whether it's, if a parent passes while they have kids or somebody gets sick, trying to make healthcare decisions. If you don't have all these documents in order, I think it really causes a lot more problems, even though just discussing this may be a difficult conversation.
So how do you get started?
Yeah, I think the biggest thing here is the first foundational document really is just last will and testament. Here, it's just that when you have your last will and testament, or aka like your will, you're really just saying, who do you want your assets to go to, and who you want to be guardians of your minor children or other dependents. And I think that's really just like, just the starting point. People think an estate plan is just a will. That's really not the case. Really, all a will is that upon someone's death, this is just a document that is submitted to the court system to decide what assets will go where for assets that pass by probate. This is just by a court system, usually in the county that you reside in. So let's say you reside in a specific county, that will go to the court system. This is a public process. So for some people, going into an estate plan, this is also part of the other thing, why people don't want all their public financial stuff going out into public. But I think that's just the first step, really. Just the will is just, just a very foundational document. But moving forward, really, is there's something called a power of attorney. And a power of attorney for legal and financial matters, let's say you're trying to sign a contract or you're trying to get certain accounts open. If somebody's unable to do that, you want to have somebody to be able to do that on your behalf and your accounts. If you don't designate somebody who's a power of attorney, it causes a lot of problems. So I think power of attorney is another important one. But I think in general, I think probably one of the most important in my mind really is the healthcare power of attorney. And I say the healthcare power of attorney is the most important because the healthcare power of attorney is really there to allow like decisions for healthcare matters while you're incapacitated. But this is not for like things that are like for like, end of life decision making. There's a specific thing called the living will that's there for like end of life decisions, like do not resuscitate or things like that. But the healthcare power of attorney, I don't know, a lot of people don't understand this, but like once one turns 18, let's say like, if you have kids, once they turn 18, let's say they go off to college, you're unable to do anything as a parent. You physically, if they get sick or anything, you can't do anything. You're not allowed to know what the diagnosis is. You can't do anything because you don't have any say over it once they turn 18. I think for parents, really, I think that's really an important piece. And as for themselves, healthcare power of attorney, you want to make sure, your healthcare decisions are really decided by those who you trust the most. And, the living will piece, when it's end of life decision, you want to make sure your wishes are really followed. And I think that's really the most important part of, your estate plan, like, of the foundational documents, because if you're able to get that, you really can have a lot more peace of mind as to what's happening. And really just, I think from there, it's really where it can get more advanced, if you will, when someone worries about like a trust or anything like that, it can get a lot more advanced. But, we're just focusing on just the foundational things, your will, power of attorney, healthcare power of attorney, things like that really are just the most crucial parts that people should focus on, just starting out the basic steps of your estate plan. And, for a lot of younger people, that will really cover everything. And maybe like another tip there would be like, let's say you have your investments and everything. An important note here is that your will is not like what you state in your will does not apply to things like your retirement plans or life insurance. So it's important to designate beneficiaries appropriately on that. Anything you state in a 401k, IRA, life insurance, like the beneficiaries, that will trump anything in a will, as those pass by contract instead of by probate, like by the court system. They pass by a predetermined agreement. So I think, just understanding that, I think is, very foundational. Having your basic documents, designating proper beneficiaries. And, a lot of times you're able to do that for like, your taxable investment account. You might have like at Fidelity or Schwab or anywhere else, like Robinhood, even non-retirement accounts, you might be able to do that. Like there's something called payable on death or transfer on death. It makes things a lot easier there, so you don't have to worry about it going through probate, because the unfortunate reality is that anything that you put on the will, if you say you want the money transferred to X person or not, it doesn't necessarily have to happen, number one. The court can decide against it, But I think the biggest thing is also probate takes time. And I don't think people really fully understand it. Like I've seen like in the state of California on a podcast, there was this like a legal person for wealth.com, a new end-to-end estate planning platform pointing out how in the state of California, probate can take 18 months. If you can find ways to, make sure that doesn't happen, that's really a lot better for families. And, having these basic documents at the very minimum means that you're able to at least have a smoother process rather than like having nothing. It makes things, a whole lot worse, making like, a difficult outcome and a difficult process even worse.
Got it. There's a lot to unpack there. That was a really great answer. Just a couple things. Just you mentioned that you need a will, that you need beneficiary. What else? Just going through
I think
that
just
list
really
initially.
just like, just your will, your power of attorney for legal and financial matters, and there's your healthcare power of attorney. I think those really are the most important, and like the living will. Those are, I think, the more, I think like the 4 foundational documents I think that are important. And then the beneficiary things are like for specific, like, retirement and life insurance. You want to make sure you have that, but as well on other accounts like banks or brokerage accounts, you're able to actually designate beneficiaries there through something called payable on death or transfer on death. And I think that really can just, make some things easier. But the thing is that at the end of the day, a lot of these financial institutions, like there's always gonna be time for processing. So I think an important piece to understand, especially for people who are married and things like that, just having a separate credit card, things like that. Because oftentimes what happens at death, accounts get frozen. So it takes time, you have to have the death certificate, everything like that. Having just something separate that will always be accessible if anything were to happen during that time. Because there's always, regardless of what you do, there's always gonna be a little bit of time in between and some delay that can be, detrimental. So it's having, a credit card or something in one's own name can make things a lot easier because, the financial institutions really don't want to get into any legal trouble. So they try to be as thorough as possible. And the court systems obviously take some time depending on the state as well.
Got it. In terms of the healthcare power of attorney, what if they're not health person related? Like they don't know stuff. Like let's say I have my dad who is a healthcare power of attorney, but he doesn't know anything about the human body in terms of health. Would that be still a good power of attorney, or do you recommend someone?
No, I would say that yes, while it would probably be better like if somebody has like the most knowledge, but the reality is like that most likely won't happen. No, most people don't have doctors or any like medical professionals usually in their family. But I think it just really having these like healthcare power of attorney is important because you want to at least make sure there's somebody like, communicating with the doctors and seeing what you think, what would be the best thing for you. It's really just somebody who should be able to, make a good decision that you probably think you would make. And I think that's really what you want. Obviously, if the person more knowledgeable, that helps. But, if they're able to find somebody, you're able to communicate well with the doctors and other, medical professionals and really come to a decision that's great for the person who has this directive there. I think that's really what you want because at the end of the day, what happens here is that, like this healthcare power of attorney, or even let's say like power of attorney for legal or financial matters, maybe this person not like a full expert. If like, let's say I give power of attorney to somebody, but I feel like, let's say with the money or the ability to sign contract, I feel like they would act in my best interest. I think that's great. Will the person have the exact knowledge that I do? Probably not, as this is like what I enjoy and I study, but you want to try to have somebody who you think is probably going to do right by you. And I think that's really the most important part.
And what is the process of drafting a will, living a will? Let's say I want to do this, right? I'm listening to this podcast and, okay, I want to take action. Do I just go to ChatGPT and maybe draft a will and then adjust it accordingly? Should I reach out to an attorney? Maybe I don't have money for that. Should I reach out to you for drafting a will or, the contractual agreements to my future beneficiary? If there is some, like, what do I do next? Like, what are my action steps?
Yeah, I think the biggest thing here is that there are some like, online platforms that you're able to like, draft your wills. And I think that's really, for a lot of people, I think that's really pretty good. Like there's platforms like LegalZoom where you're able to do it, wealth.com. They work specifically with financial planners. We don't currently use them as we have, our own in-house law firm. But I think using those tools, like if somebody has a financial planner, I would really urge you to reach out to them. If you're not getting these type of like estate planning services, you really want to reconsider who you're working with. But for people who might not be, just going to things like LegalZoom is probably the best thing because you don't really need, like when you're a lot younger, and there's not really much besides like, your healthcare power of attorney actually setting up a will. I think maybe over time, contacting an attorney could make sense. But I think a lot of times, like if let's say you just need a healthcare power of attorney, you just need a will, I think that is probably going to be sufficient because really what I'm focused on here is not what will be perfect. It's just what's something that's going to be reasonable. For a lot of people, it's not really reasonable to expect them to be able to have a contact of an attorney and do all this, 100% of the way. Rather, I just really want you to focus on like the 80, 90% where you're actually able to just get this done, get the will notarized, everything. So you actually have it. And the biggest thing is you want to be able to make sure the people who you've assigned certain things actually know of the existence of these documents, like the people who are your executors of your estate beneficiaries, having this type of dialogue, I think is important. I think Warren Buffett brought it up. You don't want to make like the decision, like after someone passes, oh, this is who has the assets. You want to have this discussion way ahead of time, so people are understanding of what's going on and where these documents are. I mean, I think further to that, nowadays with things being online and everything, I think, considering more than just these documents, if something were to happen, you want to make sure your access to social media or access to other important accounts, emails, things like that, those account information are given to your loved ones appropriately, in a safe or somewhere like where you guys both know where it is. I think that's important, like far beyond these documents, because, a lot of our lives are online and there's a lot of important things that we probably want to keep or, important documents. You just want to make sure that communication is very paramount in my mind.
Yeah, that's awesome. And speaking on the helping out your loved ones, right? Let's say me and you are a little bit older, but our parents are older of age. Maybe they're at the end of their life and things like that. And they have assets and maybe it's split among brothers and sisters and things like that. But we heard about inheritance tax. What is that and how do you avoid that? There seems to be some hacks around it. Maybe not, but maybe you have a better understanding of what that is and maybe how to avoid it altogether.
Yeah, I think the biggest thing here is this is something called the estate tax exemption. So I think a lot of people are like, they falsely believe that, let's say they die with $2 million, that there's going to be some sort of an estate tax or something like that. But that really isn't the case. Because of the Tax Cuts and Jobs Act 2017, they actually increased the estate tax exemption. Currently, for 2025, it's about $14 million, the estate tax exemption, meaning in life and at death, you can basically give up to $14 million without any tax consequences. There are forms, obviously, at death and in life that you have to, have to properly do this, but you won't really have to worry about that, at least at a federal level. Unfortunately, though, there are some states that do have lower estate tax exemptions, like 1 million or something. So there might be, some things you might want to do there, but I think really on a federal level, there's not really a concern for majority of people to worry about the estate tax exemption, especially because that's double for married couples, and you're able to actually use up some of your, let's say, your spouse's estate tax, something called portability there, but that gets like, much more complex topics there. But I think it's really just important to understand, the estate tax really isn't going to be the biggest concern for majority of people. And I think it's just, focusing on just like having these things set up. And, if those concerns occur, that's usually probably, if you have a large estate, you probably want to make sure you're working with a professional at that point, because any errors there can be very significant, especially because if things aren't done, let's say these estate documents aren't done correctly, taxes can be significant. Like in some states like New York, like the estate tax can get very severe if things are not structured appropriately. Obviously, it's very difficult to try to completely avoid estate taxes, especially if one's estate is very large, but there are some ways, to try to reduce it. And I think really that's where the estate planning piece comes in when it comes to taxes, in the tax world. But I think the other thing that will impact a lot of people here is that, like, even if, let's say you give money, let's say you give $1 million of, let's say, your traditional IRA to, let's say, one kid, let's say the person who's a doctor, and then let's say somebody else is a teacher and they get $1 million of Roth. It's actually not the same. So I think people really need to understand what's actually much more applicable than the worrying about like as an estate tax is when you're giving money to, let's say, your kids, let's say it's a traditional retirement account, they're actually going to have to pay taxes on that money, because people think of a traditional retirement account as an asset, but the IRS thinks of it as an untaxed income. Even taking deductions along the way. And because of that, what people really should understand there is that there's now usually and most likely going to be a 10-year window, which you have to withdraw this money. So I think the thing here to worry about here is just you just want to make sure that you're being like unfair to eventually be fair, tax wise. So like if there's that discrepancy with income and you're aware of this over your lifetime, that's why, these estate plans are very flexible. You want to be updating this continuously as marriages, divorces, things like that occur, as your kids get older. So then you're able to, give money. Because I think the biggest thing is like there's only like three parties you can have your money. You can spend it, you can give it, or the IRS can take money. Like that's really the only options. And I think people prefer two of those than the other. Most people don't prefer the IRS to take more than absolutely necessary. And I of that belief, no need to have less money than you should, because remember at the end of the day, what matters is what you keep, not what you make technically. So, just the planning around that, gifting maybe Roth assets to people who are like some of the doctor and, traditional assets. So let's say somebody who's like a social worker, a teacher, or something that might have lower income. So then the tax consequences won't really be as much, and you can be more fair, in an after-tax way. But, getting to more of those advanced, tax and estate matters, I think really, if you get to that position, you either, you want to reach out to a professional or you really want to start learning about, these type of things. There's some people who like to do it on their own. Some people who want, hire a professional, but, I think it's really all about what time in your life, and also just understanding that if you were to do this on your own, you have to be willing to spend the time and you want to gain this expertise. And for some people, it's not really worth it. You're doing something, you're trying to live your life, just like the investing piece. You want to try to just be able to just live your life. Sometimes it actually is worse off to try to make you just try to study each and everything. You're actually going to be spending or wasting a lot more of your time in life, and also not being able to do what you enjoy. For people like me, this is what I love doing, but that's not the case for everyone. Everyone doesn't exactly the exact same thing. So I think really understanding that is, pretty paramount to this type of decision.
Absolutely. I want to dive deeper into one of the questions. We'll talk about taxes lastly, but before we jump ship into taxes, we're always curious, right? Well, specifically me, I'm always curious what happens. Let's say my parents, they owe a lot of money from debts, maybe gambling or, whatever. They owe a lot of money legally and they pass away, unfortunately. Does that debt transfer to me? Do I inherit the debts? Do what are your thoughts on that?
What usually happens here in this case is that if, let's say, your parents have some sort of debt, you don't inherit the debt. What happens is that it's usually taken out of their estate. So let's say they have a home or something. It's usually sold. Let's say they have an outstanding mortgage. Usually they try to, take the money from that estate. And that's what usually happens. People don't have to worry about oh, I'm going to inherit, X amount of money. And I think that's really what happens, let's say with credit card debt, a mortgage, student loans. Well, once it's just for that person's life, unless you co-signed on something. If you were to co-sign, you're always going to be liable no matter what. But if it's just somebody who has this mortgage, one parent has this mortgage or a credit card, that is not a concern. But, that is a concern when it comes to what will be left out of the estate. But that's really, just what happens because, the creditors always do want to get paid, after.
But there's no collateral on a credit card. I get the mortgage aspect in the house, you get foreclosed and you go through that process. But let's say they don't have any home and it's a lot of credit card debts. There's no collateral. What happens then?
That's just with credit cards, those are unsecured debts. So that's really why the interest rates on credit cards are so high, because the credit card companies are taking on a lot of risk. So they know a lot of people will default, and that's just what will end up happening. Just like in life, people can default, it can go to collections, and then, someone else is trying to, buy the debt. After that, there's really nothing they can do. If the person's unable to pay, they're unable to pay. There's not much, a credit card company can do. But, just having an understanding, I think, just backing up, understanding of these debts and things like that are things you want to be worried about and thinking about in the financial planning process when it comes to, the estate planning, tax stuff, your investments. I think it's very important to understand that. In addition to, I think just another topic, if we have time, I think I want to go into is regarding insurance. And I think, it's an often overlooked thing for, especially for younger people. I think it's very important for those to, consider besides the estate doc stuff.
Yeah, absolutely. So let's dive in quick on insurance. Why is that important? I know we, in our previous call, we talk about like whole life or term life insurance or maybe health insurance. What are some insurance that people need to know to help them in their life?
Yeah, so I think really the foundational thing, it's important to have, let's say, people often have, homeowners insurance, auto insurance, and maybe even umbrella insurance. I think the biggest thing here is to understand with, let's say, home and auto insurance, a lot of people don't really understand how much coverage they have as, home prices go up. They don't know, like, let's say the value of the home might have gone up, but maybe the coverage, like how much, like if the house were to be destroyed, you're not going to get enough money to rebuild it. So like, understanding what is like the dwelling value, like on your homeowner's insurance that would be paid in that event. And, understanding your deductibles, I think really are important because a lot of people might have very low deductibles. Let's say somebody has like $1,000 deductible, but they can afford a deductible a lot higher. So maybe they increase it. I think that's very important, cash flow wise to understand because the lower your deductible, you're often paying a lot more out of pocket a month. And, just really understanding that is going to be, pretty important for people. And I think really the things like life insurance and disability insurance are probably the most important. Life insurance, mainly in this case, term life insurance, for let's say a 20-year period, let's say you have $1 million death benefit. If let's say somebody has kids, let's say they're just born, let's say for 20 years, they want to make sure you have protection. That's important because what happens here is that while you're working, you have income. Your greatest asset, you're earning your income. But the thing is at death, your earning ability goes to zero, at least the person who passes, but the expenses never go to zero. So what's important is that's what the life insurance is and what insurance is in general. A lot of people try to sell insurance as like an investment or anything like that. I just see insurance from a very basic principle of transferring of risk. You want to transfer a risk that is a low probability event, but if it were to happen, be very catastrophic and there's no way you could afford it. That's what insurance is there for. So you want to have, let's say, especially with dependents, you want to have life insurance. Oftentimes employers offer it, but it's not really enough. Maybe you might get $50,000 or $100,000 of life insurance through your like employee benefits. But oftentimes, let's say somebody has a good income, they have like 2 or 3 kids, maybe they want to send them to college, things like that. Having this policy will give you a lot of peace of mind to ensure, people are actually, gaining the money they need. And with regards to disability insurance, probably one the least considered, I would say, because people are like, even if they have like life insurance, they have auto and home, disability insurance is never really considered because what happens if like you're not able to work? People don't really think, oh, I'm going to like not work for 2 years or something. That doesn't really cross their mind. But the thing is that if that were to happen, that would be, a catastrophic event. And having some disability insurance, some sort of income replacement, let's say specifically long-term disability, because people foundationally should have, an emergency fund, maybe 3 months, 6 months, depending on, their life circumstances. But more longer-term disability, after like 6 months or something to start or a year. So then you're able to actually have, some coverage and, some income replacement. I think that's really something important. But, I think a note to that is, well, that's oftentimes people get this through their employer. And you have to be very careful with the wording there because oftentimes it might be if you're able to work any job, the disability coverage just continues. But you want to make sure, like, let's say you're an engineer and you want to be able to work your specific job, your specific field. You want to be able that the language there is that this is like if you're able to return to this specific job, not just like any job, because that's really what often happens depending on the wording of the insurance. I think in general that happens with insurance. Having some clarity into what is actually being covered, I think is very important and why I wanted to bring up because these thoughts. There's a lot in financial planning with the insurance, investments, taxes, estate planning, and so on. And it can get very confusing, but it's really just getting back down to the basics, I think, is the most important part for most people to focus on.
So do you recommend someone to get term insurance or whole life insurance?
Yeah, I would often just recommend term insurance, and this is because there's usually a declining need for life insurance. So let's say somebody's 30 years old and let's say they have 2 kids. After 20 years, then when they're 50, they should have probably built up some assets. they probably own their home, things like that. They have assets, and that's what should generally happen. Whole life is coverage in general for a lifetime, like in very general speaking terms. And that coverage doesn't end as long as you keep the policy in force, paying your premiums. But the thing is that since there's a declining need, it's not generally needed. There are some cases where whole life is perfect if somebody like has an illiquid estate, things like that. But that gets into a lot more advanced scenarios that does not cover a majority of Americans. And I think a lot of insurance salespeople really focus on a whole life because of the larger commissions. And there's that conflict of interest of commission. Like, I'm not against commissions or anything. Commissions are necessary for things. Like if we sell it like an annuity at Amicus, we do gain a commission. But these are things that are necessary for the client, making sure that they're able to actually spend within reason, given their circumstances and tax matters that we have to deal with. But, a lot of people, just focus on the basic principles. Insurance generally a declining need, but a lot of insurance people, and I think that's really the biggest problem in the financial services world, is that people really lack trust because they've heard this, there's this insurance person saying this, or there's this investment person saying this. But all I'm saying is, I'm not saying your insurance is the most, I'm not saying insurance, like I'm going to focus all on your insurance or only on your investments. I feel like there's, a lot to it. There's your whole life, but these are just tools. These are not just like, oh, I need to sell you this to, make money or something. Yes, in some cases, people can make money from it, but these are just products. And people, in my mind, shouldn't get emotionally attached to a product. Like, if somebody tells me a whole life and they get emotional, I'm like, why? Well, what's the emotion there for? It's just a product. It's just a thing to help somebody reach a goal. The insurance is there, your investments, these documents, they're just things that just help you to reach a purpose. And that's all I really care about. I just care about, giving your best chance of having the outcome that you desire. But a lot of people just focus on what can they make right now. But I'm worried more about a longer term relationship that will actually, benefit the person and, the families moving forward. Because I'm really just a proponent of education. Why I jumped on this podcast, because just educating, especially the younger population, I feel like is pretty important given our lackluster financial education in school, which I, for one, know very well as I graduated in May of 2024. I know like how the education system is not really great when it comes like educating you in high school about, what's investing, what are taxes or anything like that.
Yeah. Well, one, you just explained what a good salesman is versus a bad salesman. That's one. And number two, I think in school, I remember in high school, I only took one personal finance because I really enjoy it, because the guy used to work at JP Morgan and he'd talk about like investing and things like that. While all the other kids didn't really focus much on, they just wanted to get a good grade and like, pass the exam and things like that. I was like, this is actually pretty good. And I think that was the seed that allowed me to grow to the financial, the journey that I am now. And speaking about the insurance, just real quick, right? Because I spoke to a couple investors. I'm in real estate, obviously. I spoke to a couple investors, and they said that with the whole life, you could borrow money out of it, and you could use that to invest. Is that something that you touched on or have heard before, or maybe people use it already? Do you feel it's a benefit?
It's because whole life, there's a cash value component in it where like you build up cash value, but I think it's really more of a sales tactic, if anything. Yes, it's true. You're technically able to borrow, but it's just the language that is used. It's like you're able to borrow tax-free or whatever. The thing is, you can borrow from your investments. You can borrow on your home. There is no like tax consequence to borrowing. There might be interest costs, things like that to borrowing, but they're making it seem like it's like a new thing. And I think that's really what I hate, really within the insurance world, is that there's so much framing around like this is like something like very novel. Yes, there are substantial benefits. Like there could be benefit to whole life, term life, any other of the variations of insurance. But, just trying to sell it to people in a way that it's not, I think is very misleading. Like there are advisors I know, like Andy Panko, there's people who are selling IULs or all these various types of insurance products. And he really just tries to bring to the point, it's not about hating the product. It's really about not disliking the way it's sold. I think that's the most important thing. You want to be honest, and I think the integrity is the most important piece for me. And that's really why I'm joining this profession, because oftentimes what occurs in the financial services profession is that there's not a lot of trust and there's not really a lot of focus on the client. There's
more focused on how much can I make. But I'm more of a believer that if you provide great services, you're going to make money. And yes, you can make money through commissions, things like that. But if you're just focused on, let me just give you this, like, let's say this whole life product and you can't do anything else, I feel like, that could be very limiting, but like depending on how you're doing it. If you're giving it to people when it's necessary, things like that, that's great. But a lot of insurance people just focus on it, like I just have to sell this to any person who walks through the door. But a lot of great insurance people I know, they focus more on, let's build relationships with certain advisor, and they're actually providing things. They're stepping in when the advisor might not, because they're not insurance licensed. I think that's really what should happen, because, insurance objectively is important. Investments, estate planning, all this is important. But, a lot of people try to make one like more important than others. Like relatively speaking, it can be more or less important given certain situation, but they try to like make like this is the only thing that should matter. But I think it's really, understanding the conflicts of interest for the individual is important, especially when you get to that step of, if you get to the step of, I want to hire like a financial planner or something, understanding their like investment philosophy, like do they believe in indexing? What is their planning philosophy? Things like that. You really want to understand that before, go into that relationship. Because just like anything in life, you really want to understand what relationship you're getting into. I think getting education from podcasts like these really does help a lot of people out.
Yeah, good stuff. And you're definitely helping a lot of people out in this podcast with the amount of knowledge that you had. I wrote down a lot of notes. So moving on to the next topic. Have you ever heard about the buy, borrow, die strategy?
Yes, I've heard that often on social media.
Give us your thoughts on that. Is it true?
Yeah, I mean, like the thing here is like buy, borrow, die strategy. The main thing here is that like somebody, let's say they purchase something, they're borrowing money, everything, and in the end they died. Like this is just really like a tax strategy, if you will. And I think the main thing, this is true from the perspective, like, like the thing this is really trying to get at is like, for social media, this is just like more of like a clickbaity type thing. But
sure.
the main thing here is just understanding that, at death, when it comes to taxable assets, like let's say your home, your brokerage account, things like that, they get a step up in basis. So let's say you paid $300,000 for something at death. If it's worth $500,000, that's the new basis of the beneficiary. So if they were to sell it, there's no taxes. And that's really where this strategy comes from. And I think it is very true. It's just the way that I think social media like perceives this is just like something that is like, only certain people know. And that could be the case. But I think it just really just what's the most important to me is that you're understanding like these strategies do exist. But what you have to really focus on is what is the best strategy for you. Just because these exist don't mean you always have to use it. Like, borrowing against everything because borrowing is not taxed. Yes, true. And yes, if you die, then it gets step up in basis, everything like that. But what people don't understand, like, let's say you're borrowing, you're taking on risk. There's always there's risk to that. So, really understanding detailed matter what you're going into, especially when it comes to any tax strategy, because unfortunately, a lot of tax strategy on social media is either like a half truth or completely misleading. And I think that is the unfortunate reality. So really vetting like, who your tax person you're listening to is very important, because I've seen like a lot of strategies like, you open an LLC and you're able to deduct all your personal expenses. That's nowhere true at all. Or like some people trying to abuse the ordinary and necessary expenses for your business. Like, you decide what's ordinary and necessary. No, that's not how it works. Ordinary and necessary is defined based on the tax court opinion of what is deemed ordinary and necessary. Like, let's say you're getting a haircut or you're trying to get like certain things that are inherently personal. Those are not ordinary necessary in the pursuit of income. And like people try to like, misuse these sort of statutes that we have. And I think that is very detrimental. And this is really preying at people who just don't have the knowledge, and why I'm really, I dislike those professionals, but like those, not even professionals, just the people who engage in that type of, sales or like behaviors. And I think that's really something you want to, be wary of. When you hear of a strategy, you really want to research it further, not just take it at face value, because there's often either a motive, one or two, and it doesn't apply to everybody. Even if it's a legitimate strategy, it might work for, let's say, one person out of 10, but it doesn't work for you because the situation is not even the same. And I think that's really something that's, pretty important, especially in the tax world. It's something like a real estate person, actually understanding, what applies or what doesn't.
100%. Have you ever read the Rich Dad Poor Dad?
Yeah, I have not read it, but I've heard, a lot on podcasts and things like that about Robert Kiyosaki.
Yeah, so Robert Kiyosaki, maybe he created this, maybe he invented this, was the cash flow quadrant, right? You have this 4 quadrants. You have the investor, the business owner, the self-employed, and the employee, right? And for whatever reason in that book or how he phrased the employee is like the bottom of the pool. But that's literally majority of everyone, right? They usually have a job, W-2, maybe 1099, but let's focus on the W-2. And they go to work, they pay taxes and maybe deducted automatically from their employers, from the payroll, and then they could, pay some of their 401k, and then whatever's left is what they use to live, right? And in a tax world, it seems like since majority of people are W-2, it seems like there's no way that they could reduce their taxes, right? The typical people who are W-2, maybe they file their taxes, they have to pay taxes, and then they get deducted from the standard deduction. And that's it. For people who are just getting day-to-day, they're like, I hate paying taxes. Is there any way to have them reduce their taxes besides opening up a business or things like that, especially their ordinary taxes?
Yeah, so if somebody is W-2, it is true that there's not as many ways to reduce taxes as there are for business owners, but I think a distinction here has to be made is that, let's say like for a business owner, a lot of what they can deduct, these are just like expenses, necessary for the business. And the reason is because the IRS only wants to tax you on your your actual profits. You don't want to be taxed on your revenue. So I think that's one thing to bring up. And the other thing to bring up is that, let's say real estate, like there's all these depreciation expenses, things like that. And a lot of people, I think they misuse this often because what people don't understand is really a lot of these tax strategies, some of them are actually more of a deferral strategy more than like getting rid of tax. It's just pushing the tax can down the road. So I think that's really something, important for people to understand. But shifting to the W-2 employee, there are ways to reduce your taxes, not as many as like a business owner. But, when you're a W-2 employee, you're able to, let's say, contribute to your 401k if it's a traditional 401k. But I think what really is important here is that a lot of people focus on taxes today. And that is not always the correct thing to do. Like there are taxes you're paying this year. Let's say you pay in 2025, you pay taxes, but there are taxes you're going to be paying out throughout your life. So like, let's say somebody is young, right? Let's say somebody gets their first job and let's say they make $70,000. Well, like they're, I don't want to pay taxes. Let me make the max. Let me make $20,000 contribution to my 401k. And now I only am taxed on $50,000 on my tax return. I'm taxed on $50,000 on the federal and state level. That's great. But the thing is now there's going to be tax consequences in the future when you're withdrawing money. So really what you should be worried about is not taxes today. You should be worried about taxes throughout your lifetime. So really you want to be doing what's best for that. So like, let's say you're young, you don't want to really be taking a lot of these tax deductions like for 401k. You want to be paying taxes. Let's say you start your first job or you're working in high school or college, contributing to your Roth IRA. You're not getting a tax deduction now, but you're getting tax-free growth. So there's taxes somewhere. But maybe today is you want to pay taxes because you're not paying anything, especially like a college student or a high school student, you're paying almost nothing in taxes. So there is no benefit to deducting. And I think, getting into the mentality of, your lifetime tax bill then today is most important. And I think another thing, besides like, let's say your 401k or IRA, like traditional versus let's say Roth, it's important to note that when it comes to like your, let's say health insurance, some people can, depending on like they have a high deductible health plan, like you have a high out-of-pocket maximum, high deductible, everything like that, you can be qualified for something called a health savings account. And an HSA actually can have, a triple tax advantage. So this is great for a lot of people trying to reduce your taxes, getting that tax deferral and pulling out tax-free when it comes to your healthcare expenses. But what people focus on here is like, that's the tax things are great. But you really want to make sure is that appropriate for your life. For some younger people, it can be great. But you really want to like put more perspective on that. Like, is that great for you? Like, are you able to afford these higher deductibles and out of pocket? If you're able to do that, these strategies could be, very great for you. I think that's really what you should focus on. Like, I feel like tax is always secondary. And I always say like, the mantra of just like, you can't let the tax tail wag the dog, essentially, like, when it comes to investments or anything else. Taxes are always secondary. You pay taxes when you make money. Yes, that can be, a burden. You want to try to reduce it. And in some cases you can, but focusing on that exclusively is, I think, missing a lot bigger of the picture. There's much more life than just taxes, but, there are certainly ways to optimize, but, this is like optimization. Optimization is always second to the primary behaviors of, you actually save money, you're actually budgeting, you're actually contributing to, let's say, your retirement or taxable account. You're actually making these like 80 to 90% things like the most important, and these optimizations come secondary to that.
Got it. Makes sense. So in this entire episode, right, we covered a lot of topics. So we talked about indexing at first, and a little bit of financial planning, estate planning, insurance, that we dove deep into taxes. At the end of the day, right, there are so many nuances in the financial world, especially in the personal financial world, to make sure that the T's are crossed and the I's are dotted. If you could summarize for someone maybe in their 20s, someone in their 30s, someone in their 40s, just generally speaking, like, what is the best way to grow wealth?
Well, I would just like, really just in summary there, just growing wealth is really just about, focusing on things that are in your control. So you can control most likely, your income ability. If you're just get very skilled at your profession, maybe start a side hustle and just do very good at those things, keep, your investing costs low and, index, like have a global index and just focusing on those type of behaviors. You're actually budgeting, whether it's like on Excel or through things like Monarch Money, where you have your accounts connected and you're actually able to see your income and expenses. When you do those basic things, that's really going to help you, build your wealth. And then, as you're building wealth, or even before that, you want to understand, how to protect it. And that's where insurance, estate planning, things like that come in. But, you have to just do step one. You have to really take inventory of what you have, what you're making, and what your goals are. And I think that's really the most important part, because let's say you can have all these goals, like, you're doing goal formation and quantification, like, oh, I want these goals, this is how much it's going to cost, but you have to understand where you are today. So once you understand where you are today, you're able to, back into those things. I think that's really the most important thing. You just have to get started. If it's starting your first budget, opening the investment, I'm not even investing, just opening a Roth IRA if you're eligible, actually joining your 401k plan, just starting is really the biggest thing. Then you can optimize, but just start, like, let's say your 401k plan, you start, let's say, invest in the S&P or like, US or an international index, you just get started. And I think that's really the most important thing. Like, after like all the time I've spent, learning about this, like, I got tied into a lot of like optimization, but the optimization means nothing if you never start, or you're not focusing on the basics. Like, let's say you're trying to optimize investing $1,000. That's not going to really do much. Like, after optimizing, if you have millions of dollars, yeah, great. But if you just get started, you can get to that point. But if you're just like so worried, then you're not going to get there. And I think that's really the most important thing. And, if people have any questions, feel free to, reach out on my LinkedIn. I think we'll have it like linked somewhere on this podcast. I think that's really the biggest thing. Just get started. If you have a question, reach out. I'm more than happy to help you. I can't, give any specific, tax, legal, or investment advice, obviously, but, just, getting started, making the first move is really often what pays, the greatest dividends. I think that's what I want everyone to really take away from this episode.
Yeah, that's awesome. Keep the main thing, right? Taking actions, do the work, and then all the optimization can come after. I think that's just life in general, right? We focus on these, especially in the real estate world. We focus on, oh, what type of deal should we get, or how much money that margins, or maybe I'll focus on the property management side, but you have no deals whatsoever, right? And same thing with the personal finance side. Oh, I'm going to create the best Excel sheet with the revenue and my expenses, going to create an account on Monarch Money, going to open an M1 account, like, but you ain't making no money yet. Like, where is that money going to? Focus on the biggest thing, which is the income that's coming in order for you to diversify in whatever many different buckets that you want to do. Yeah, that's awesome.
Completely agree there.
Any last like resources that you may provide? You mentioned Monarch Money for budgeting. What about maybe news channels so people could have a better understanding of where to find the best finance, kind of up-to-date stuff for stocks or indexing or just life finance in general?
Yeah, I would say when it comes to like the investing world, there's a channel, his name is Ben Felix on YouTube. He's a Canadian advisor, but he has a lot of, evidence-based, things about the principles of indexing. I think, learning more from that, I think is, very beneficial for the audience. And as well as, following on my LinkedIn, I usually often post some things, I'll be posting, all the resources that I've used, like on my journey in the financial planning space. I think that are, helpful for everybody just to, learn about, topics that in my mind, are important, who I follow and everything. I think that's really, the first step for people, and, just getting started, learning about investing, following me. There's going to be a lot of, great insights you can gain from that, and just starting from there, really, I think it's, to me, the biggest problem I had was just like, whenever somebody's like, oh, there's all these people you should be following, like it can get overwhelming. But if you can just start from one place and then, just go from there slowly, I think is the best thing you can do, as you're vetting the person. Is this actual information, things like that. But once you have like a list of like 10, 20, 30 people, it gets harder. And I can like understand that, I'll provide those resources if anyone reaches out, or just on LinkedIn in general. But, I think the biggest thing, just start from step one and, just take baby steps, moving forward, not just like running to like what I do at 11 p.m. It's like, oh, let me just learn on this newest tax thing, or the like whatever like Congress is trying to do for the extension or non-extension of the Tax Cuts and Jobs Act. Like, it doesn't apply to most people. It applies to me because that's what I work. And, you want to make sure our clients are taken care of. But, a lot of people just don't have to worry about, to that extent. So I think that's really the biggest thing for people to take away from that.
All right, good stuff. Usually we play a game, but the amount of knowledge and education that you provide in this entire podcast is awesome. You mentioned that we could find you on LinkedIn. Is that the only place, or is there any other place that we could find you at?
Yeah, it's just mainly LinkedIn. I'm going to start, posting, more videos, things like that. I think on my LinkedIn, I do have a YouTube video, I think a 30-minute video on my LinkedIn, just some like basic things, about investing and insurance that people can watch. You can gain, a little bit more insights. But I think, just reaching out if you have any questions, I think is the best thing. Because, for some people that was the biggest thing for me, just, finding people to connect with. Because learning all this is very difficult, but then like getting it digested very easily from people, I think is the best thing I've got. Reaching out to other experts and advisors is really how I've been able to, propel my knowledge to where it is today, and hopefully, significantly more in the years to come.
Awesome. All right. Well, Joseph, thank you so much for the immense amount of knowledge. I took down a lot of notes. We'll put some of the summary in the show notes, and we'll put your LinkedIn on the show notes as well, and all the other resources that you mentioned. Thank you so much for all the knowledge. Again, this is super, super awesome.
Yeah. Thank you so much for letting me join the podcast.
Awesome.
Thank you so much for watching or listening to the Kaizen Blueprint podcast. If you got value from today's episode, be sure to like, subscribe, and leave a review. It really helps us grow and reach more listeners like you. And don't forget to stay connected. Subscribe to our newsletter at kaizenblueprint.com for exclusive insights, resources, and updates. Keep striving for growth, take action. And remember, small, consistent improvements create massive impact. See you on the next episode. Peace out.